Let's get on to the earnings treadmill, and I think CEAT is the first one.
Well, that's right. Let's focus on CEAT. That's the management on our radar. Earnings were better than estimate. The revenue growth has been good, driven by domestic demand, both in OEM as well as in replacement market. But margins, they've slipped a little bit on higher input costs. To discuss this and more, we're joined by Mr. Arnab Banerjee, the Managing Director and CEO at CEAT. Hi, Mr. Banerjee. Good morning and good to see you in as always. Congratulations on a good showing actually in the past year. Double-digit revenue growth, double-digit growth even for Q4. Give us the outlook, though, from here on. For FY26, can you continue to grow in double-digit on the revenue parameter? And since you get more than 50% of your money coming in from the replacement market, what's the signs in terms of the economy? How are things on ground? Please go ahead, sir. Mr. Banerjee, I think you'll have to unmute yourself, sir.
Going forward, we would definitely like to carry this momentum of double-digit growth overall right through the year. The trends that I talked about last time when I was around continue. In domestic aftermarket, the urban market is urban areas, which is greater than 50,000 population towns, is a little soft on demand. Rural areas are doing much better. There is a clear delta of 4 to 5% incremental growth in rural for us, and we have the distribution reach to tap into that, so that's positive. OEMs, we expect the approvals to keep coming in for larger rim size tires and passenger, which I've been talking about, which we are focusing on. And we would like to see our share going up in that area, as well as in truck bus radial and two-wheeler. So OEM, we are bullish vis-a-vis visibility that we have on approvals and the sale of those vehicles going up in this FY26. Globally, it is uncertain, as you all know, because of the tariffs and even other ongoing things, the war and some of the tariff and non-tariff barriers. So it will continue to be uncertain. So in balance, I would see most of the trends of FY25 continuing in FY26.
All right, so double-digit growth is what you're gunning for. Could you tell us what about the inorganic growth? You had made that Camso acquisition, and as you said, I think it would add roughly around, ballpark, I think 2,000 crores on your base of close around 12,000 crores approximately. Does it start contributing in this year? And what are you penciling in out of that? And this double-digit doesn't include Camso, or does it include it?
This is standalone.
Standalone.
Yeah. So Camso would be integrated into our business in Q2. All the antitrust issues are now done away with. All regulatory decks are clear. We are in accelerated mode of integrating the business. Q1 will not have any consolidation from Camso side. Q2 onwards, we will be starting to consolidate the Camso results into our system line item wise. It's too early to say how that will pan out because there is some turbulence always when a new set of owners come in. But we would like to focus on business continuity, retention of talent, retention of customers in the first 2-3 quarters, and then we'll take it up from there.
All right. Mr. Banerjee, good morning. How's demand for the recently launched 3 tires targeting the premium segment? And what's the market share in that segment currently?
The 3 tires that we launched are Run Flat tire, which is the first time an Indian manufacturer, Indian brand is bringing to India. 21-inch rated tires and Calm tires, which is very relevant for the electric vehicle trend. These are niche products right at the top end for top end cars. Volumes are very small at this moment, but we expect to take a pole position there. This is going to grow in future, and this is especially 17-inch plus volumes in passenger car tires is just going to skyrocket as a proportion of the entire aftermarket. So volumes are still small, so market share doesn't make any sense to talk about right now, but we expect to have a leadership position going forward.
Mr. Banerjee, in the third quarter, I think at the end of that quarter, in the analyst call, you had pointed out that your overseas business was growing really well. You were seeing good demand from Europe. Now, with this whole trade disruption, what is the expectation? If you could just give us the split between the international business and the domestic business, and then also the split between the growth trends, volumes that you're expecting on both fronts.
So about 19 to 20% is coming from international business. This doesn't include Camso. This is CEAT standalone. And that ratio is being maintained right now. You're right. We have done very well in the EU area. And we continue to do well, and that's the most stable part of the business, good on margins, good on growth. In all categories, in farm, OHT, passenger, as well as truck bus radial. The US business is small, but that's a future growth area. So the risk there is to future growth, but as of now, the exposure to US and therefore the impact of what's going on directly because of the tariffs proposed by US is not going to be material in FY26. There are headwinds in other parts of the world also, for example, Latin America. The areas which are doing well, apart from Europe, are Middle East and Southeast Asia.
Just to follow up on this, are you hearing any of your European clients, the big OEMs, talk about delays or deferring, any of their plans? Because, for instance, I mean, look at Tata Motors. They announced a halt on all JLR shipments when this tariff news broke. So are you expecting any sort of a slowdown in the European business? And also US, since you mentioned it's still an opportunity, just tell us what sense you make of the tariffs. The news changes every day. Now we understand that they're quite open to components still coming in. So would you look at expanding your presence in the US at all?
No, US is definitely a future growth market. As I mentioned, we are already present with our OHT business, which has started taking shape. We have just launched our truck bus radial and going to launch our passenger car radial this year. We are setting up our network. So nothing is stopped. We'll have to see the business model and the profitability and the product range that may get altered. We are hopeful of suitable, free trade agreement between the two countries coming along by the fall season. But if things stay where they are, India as a country doesn't have a competitive disadvantage vis-a-vis the US market, vis-a-vis other country as competition, which is, let's say, China, Thailand, Vietnam, etc. But things are fluid. It will evolve. We'll wait and watch. And as I mentioned, no material impact in FY26, but it's our growth market, and we are keen on investing in US.
Okay, all right. Mr. Banerjee, the raw material costs have cooled off, and that's what's helping your gross margins improve. I think the last time around as well, we briefly spoke. Your target, I think, is to get the gross margin back above 40%, and that could happen in the coming quarters. Given that, what kind of a EBITDA margin should we be working with for the coming quarter? Will quarter one be better than quarter four? And from then on, do we see some kind of stability, a margin band, if I could request you for one?
Yeah. So let me first talk about the raw material situation. Quarter four on quarter three, the crude prices actually didn't change much. Quarter one is definitely cooling off. So crude derivatives will gradually come off their current price levels going forward. Natural rubber international prices have come down to about $1,700 per ton, but domestic price is still holding steady at around just lower than 200 rupees mark. So that has not come off. Rupee has just now started appreciating, but it was depreciating earlier. So there are various factors at which we are looking at. The entire basket, if you see, quarter four and quarter three, it was almost flat, minor drop. Quarter one on quarter four will see a very little drop, almost flat. Quarter two onwards is when we see raw material prices probably cooling off significantly. And that is when margin expansions may happen. And you are right, we are comfortable operating at 40+% margin. So it will take a while to get there.
EBITDA margins should hold in that vicinity of around, say, if you want to give us a range for the year, given that the benefits will flow in from the second quarter, should we be working with a rough number of, say, around 12 to around 13%?
We would like to go there, but it's too early to sense of what it will be at this point.
Got it. Just a quick question as well with regard to your capacity. Last year, I think you spent closer to 1,000 crores on Capex. This year, what is that number that you've laid out in terms of a Capex? What is your current capacity? Where is it headed? And what does it mean in terms of your debt?
Right. So on a standalone basis, again, I'm taking the Camso thing out. We will continue to spend around 1,000 crores, maybe 900 to 1,000 crores or thereabouts in terms of Capex. About about three-fourths of that will be growth Capex, and all will be continuing on the same brownfield expansions at Chennai, both passenger and truck bus radial, at Ambernath for OHT, and maybe a little bit in Nagpur as well for two-wheelers. So mostly brownfield expansions is going to continue. And capacity utilizations are around 75, 80. In some cases, it is close to 85, 90% passenger car tires, which is why we will expand at Chennai.
And debt number, sir? Or what is it? Where is it headed?
Debt numbers have gone up by about 100 odd crores, little less than 100 crore vis-a-vis Q3, as you have seen at the end of Q4. So as far as standalone business is concerned, it will be around similar range because we expect cash accruals as well. And with the Capex at 1,000 crores, not much imbalance is expected in the overall debt. Minor change maybe there.
Mr. Banerjee, you used the word this was in relation to the answer on premium tires, the newly launched top-end segment. You used the word skyrocket for one category. What was that? Which one was that?
All the premium, the entire premium segment, which is large rim size tires, is going to, right now it is just about 10% of the market. In terms of salience, this is going to really, really grow very fast in the next 3 to 4 years.
You know, Mr. Banerjee, allow me to ask a tongue-in-cheek question. This is coming in from a viewer, a very troubled viewer who's got to drive on Mumbai roads. He's asking me to ask you whether there is any bump in demand, especially for what you sell in Bombay, in terms of replacement demand or otherwise, because of the condition of roads.
Yeah, can I add a question to that, Prashant sir? Also, can you invent a tire that remains absolutely puncture free, resistant to Mumbai roads? On a lighter note, we're just joking here.
No. So run flat is very close to that. Flats are supposed to take care of any such issues, and you can travel up to 80 kilometers till you tend to the tire. So there is a very big consumer proposition, especially for the higher end cars. So yeah, it sort of addresses that problem, Mumbai or otherwise.
You've tested those on Mumbai roads, Mr. Banerjee?
We tested them on much worse roads.
All right. Well, we'll leave it there. Thank you very much for coming on and being a sport about it, and of course answering all those questions with regards to demand, etc., and the outlook at CEAT.